So again, real GDP over time. If you look at this graph, every time we have a recession, GDP goes down, right? So down, 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 down. Sometimes more down, down than others. Down, big down, right? So this looks more like it flattened out than it went down, but it's all right. And then a big down here, and then it goes back up, and you can see that it takes years to get out here. Now the reason, then it starts down here at the bad part of 2020. Okay. GDP over time, this is GDP, not real GDP. Why do we need to take prices out of GDP? Because during the 70s, we have a lot of inflation, and you can see that in most of these recessions through here, it's a recession. The bar is recession, right? These whatever purplish color bars are the recessions. And you can see where the recessions are on the real GDP graph. But when we just look at GDP a lot of times just keeps going up. Even though it's a recession, GDP is going up, and it's going up because there's inflation. And the inflation is faster than the fall in GDP, and so GDP keeps going up. So even though we're producing less stuff, it looks like it's going up, and it's not really until the Great Recession here, 2007, 8, 9, that we get a significant fall in GDP, regular GDP, right, during a recession. There's little adjustments back through here, right? But right in here, we have 10% inflation. It's going to counteract the appearance, at least, it's going to counteract the appearance of the recession. Okay? So who decides that it's a recession? The answer is there's a committee at the National Bureau of Economic Research. I don't think they do a very good job personally, but that's just me. Okay? The NBER, they're the official people who officially decide that there's an official recession, the National Bureau of Economic Research. I think I should get to decide. What happens during recessions? Well, first, before the recession comes, we often get signals. The economy tells us that something's wrong. And even let me be clear. With ignoring coronavirus, for the 6 months before coronavirus hit, there were recession signals coming. The Federal Reserve was already doing things, and we'll talk about this when we talk about the Federal Reserve. The Federal Reserve started doing the things you would do to fight a recession 9 months ago. Okay? They wanted to try to prevent a recession. So, what are the signals of a recession? Well, for 2016, 2017, 2018, every one of those years, corporate profits were going up. And in 2018, we had record corporate profits. In 2019, we still had record corporate profits, but they were basically unchanged from 2018. So we'd been having corporate profits get bigger and bigger and bigger, and then they flattened out. And they flattened out in 2019 after we gave them a tax cut to increase their profits. So it's likely that if we hadn't increased or hadn't cut their taxes, their corporate profits actually would have gone down in 2019. So we had rising corporate profits and they flatten out. Usually corporate profits start to get weak before the recession starts. Okay? And a lot of debt. So in 2019, we set the all-time record for the ratio of corporate debt to GDP. So even though the economy, quote unquote, was booming, we had this horrible debt load. If you looked in Las Vegas, we had these casinos that had $10 billion in debt, $15 billion in debt. They were just in debt up to their eyeballs. And they've done some things to try to get rid of that debt, fortunately, before the big coronavirus stuff hit, or we might have lost some of them. Okay, but we saw an increase in personal debt and an increase in business debt. That's usually a sign that a recession is going to happen. And then we got what we call an inversion in interest rates, and we'll talk about this mo. interest rates are a measure of risk. The riskier you are, the higher the interest rate you have to pay, which means normally that long-term interest rates are higher than short-term interest rates because the future is inherently more risky than the present. You don't know what's going to happen. Okay? When those two things flip and long-term interest rates go low and short-term interest rates go high, there's always been a recession. Every time that's ever happened, and in fact, every recession in the last 50 years, that inversion has happened before the recession, and that inversion happened at the end of 2019. So again, a sign, recession was coming regardless of the fact coronavirus was coming. So ignoring coronavirus, we would have expected a recession to happen in 2020 at some point. Okay? As the recession starts, spending goes down. Businesses really chop investment spending because investment is about the future. If you're not selling your stuff now, you don't need to invest in the future. And consumers start spending because they start getting worried about their jobs and their income. Okay? We get what's called unintended inventory accumulation. That means, really simply, that businesses have stuff on their shelves that they thought they were going to sell that they can't sell. So they have unintended inventory. They have an unintended accumulation of stuff. So the government tracks inventory as part of the GDP analysis, and inventories start going up. And they start going up with businesses not intending that they go up. They just start going up. And that's an indicator that you're in a recession. Exciting. Okay. To end the recession, spending starts again. Recession ends when spending starts again. And again, we don't have a whole bunch of theory in us yet, but there are people who will tell you that that's not why recessions end, and they have other theories of why recessions end. But most economists will say the signal that the recession is ending is that people start spending again. Consumers and businesses start spending again. Okay? But I don't want to lead you into the idea again that there's one theory that everybody believes in macro, because there is not. All right, so I have some graphs for you. This is inflation in the United States of America. And I want you to look here at the recessions. Recession, inflation goes down. 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 Is there a pattern? There might be. So, going back to 1960 here, every recession we've had since 1960, inflation has gone down. And if I drew this graph back further, the same thing is true. Okay? When we're in a recession, inflation gets lower. The recession takes inflation down. And you would think that, right? Because when our economy's not doing well, demand goes down. When the demand curve goes down, it takes prices down. So we should see less inflation whenever there's a recession. Just basic supply and demand. Okay? Unemployment. If you look at unemployment always goes up during the recession. So unemployment. But let's be clear that unemployment keeps going up a little while after the recession's over. Everybody see that? Unemployment really doesn't jam down right away. It pushes out a little bit past and especially here in this wacky recession. Okay? But in unemployment pushes out and doesn't go down right away. Okay? So it'll be interesting to see if you look here again at unemployment, it's way up here at that. And once we get data that tells us what happens, it'll be interesting to see how fast that comes down. All right? So unemployment tracks with recessions too. Unemployment goes up during recessions and usually continues to go up even a little bit after the recession is over before it starts to come down. Okay, Since the early 80s, we've been in an economic period that economists call the Great Moderation. And I mentioned this before, I'm saying it again. The Great Moderation means the up and down swings are a lot less. So if you look at inflation, this is the inflation graph we just saw. We have all this, and then inflation just calms down, and it's just 2%. It's just 1.5%, 2% every year. Okay? We have economic growth, sometimes up double digits, boom, 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 boom. And then all of a sudden, we're 2.5%, 3% most years. Occasionally we hit 5%. Occasionally, we're a little, we have the big downward bumps, a couple big bumps. But basically, we were, now we're, okay? So inflation is lower, growth is slower, everything is just moderated, and everything's smooth. Now, some economists think this is a good thing, that we're all this smooth, that maybe that means we are mostly over time going to have fewer recessions and fewer economic problems and everything's going to be better. And then there are other people who think, hey, we'd rather have more growth, and coupled with faster growth, then maybe you get more inflation or maybe you get other things. China has much faster growth than the United States. They also have much higher inflation than the United States. So there are other economists. Remember, everything's a trade-off. No such thing as a free lunch. So if we're going to have more growth, we probably are going to have more inflation with that. Which do we prefer? Low growth and low inflation, or higher growth and higher? I don't know. Okay? The Great Moderation. So, the Great Moderation, and actually since 1950, if we go back to 1950 and compare 1950 to now versus pre-1950, the average expansion in the United States is between 2 and 3 times longer than it used to be. We've made our expansions much longer, and the recessions are actually less than half as long as they used to be. So we've shortened the recessions and increased the length of the expansions. Even though in total, maybe, we're growing slower, we're growing more consistently at that slow rate, and we're not getting all this bounciness. You see all this down and down and down and down that's happening here. Well, we don't we've calmed a lot of that down. Okay? There's more to it. It's a much more complex story. Prior to 1970, there was never an expansion in U.S. history that was longer than 3 years that wasn't part of a war. People used to talk about the United States having a war-based economy, and congressmen used to joke when the economy wasn't good that we needed a good war. The U.S. economy only grew we only had expansions longer than 3 years in American history, up until the 80s actually, that we weren't in a war. So we had the Vietnam War, Korean War, World War II, World War I, Civil War. Those were all really great long expansions in American history. Okay? Now, we had a really long expansion in the 80s. We weren't in a war. We had a really, really long expansion in the 90s. We weren't in a war. We just went through a 10-year expansion. We actually were at war, but I don't know that war actually helped the economy. It might have hurt it even. So the economy's fundamentally changed since World War II in ways that we don't even completely understand. Okay? All right. So your book suggests that maybe we have more stability in our economy for a variety of reasons. Maybe, but at the same time, we have issues. So we have this record corporate and personal debt as a percent of GDP, not just in total, but as a percent of GDP. We also have record corporate profits, which is odd that you would have corporations racking up more and more and more debt at the same time that they're racking up more and more profits. And some of that is the fact that interest rates are so low. So you have these what we call zombie corporations that aren't making any money, but because they can basically borrow money for free or very close to free, they're able to finance their operations by borrowing, and they stay in business even though they're not making any money. Right? JCPenney's. During the recession, we're going to lose right? So in 2020, a whole bunch of those companies are going to go bankrupt, and either they're going to shred off their debt and their debtors are going to lose and they're going to stay in business, or they're just going to go out of business. So on one side, the successful companies are enjoying record profits. On the other side, really low interest rates are allowing these not successful companies to stay in business, and we're getting record debt at the same time we're getting record profits. We've had historically low interest rates for long periods of time. When we get to some of the later chapters, there are theories that say that is the worst possible thing you can do, and we'll talk about those theories later on. On the other hand, we've switched from being mostly a goods economy to mostly a service economy. And service economies traditionally are less affected. So you go get your hair done. You still go get your hair done during the recession. You might put off buying a refrigerator, but you still go get your hair done. So services tend to be more resilient than goods producing. Though, again, now in the coronavirus thing, the services took a bigger hit than the goods producing parts did. So you can't always say that. We do have a much broader government safety net. So there's unemployment insurance, and then if you don't have unemployment insurance, you can't qualify, you use it up. There's a whole bunch of other government programs to help you with housing costs, to help your school lunches, to help you eat. There's all these government support programs that help people that weren't available in the 1930s during the Great Depression. Okay? And there's protection for banks that wasn't available during the 1930s. We're more active. Our government is more active. The Federal Reserve is always doing stuff, and during the coronavirus time, the government was passing laws, passed a number of laws to try to help the economy out. So we have that. And your book suggests that maybe we have a more stable financial system than we used to. That is a huge debate among economists at this point, of whether the financial system is more or less stable than it was. And in politicians, too. There's the last election, there was a law called Glass-Steagall that was taken out, and we might mention that later on in life. But you had Bernie Sanders who wanted to put it back in, Donald Trump who wanted to even take more parts of it out, and Hillary Clinton who was in between the two of them, liked some parts of Glass-Steagall and not parts of others. So you can easily find people who think our financial system is grossly more unstable now than it used to be, and you can find people who think our financial system is more stable now than it used to be. Jamie Dimon, the head of J.P. Morgan Chase, the biggest bank in the world, said, we're better off now, our financial system is better off now than it's ever been, basically. Okay, so now we're going to go to just talk about long-run economic growth and do that in more detail.